Okay, welcome back to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play, and today we're going to be talking about a very important topic for all options traders. Even though we're not going to be talking about options, risk and money management of trading in general is one of the most important things that you have to learn as a trader. And it is quite different if you're a stock trader versus options trader in terms of managing your risk and managing your money, because with options trading, you are putting a significantly smaller amount of capital at risk per trade. However, you have a much higher probability of losing a large chunk of that amount of capital that you're putting up at risk. So it's really important to understand how to manage your risk and how to manage your capital so that you can survive trading in this particular market. So this is one of the things that I want to go over to here today is understanding how do you actually calculate your portfolio risk? How do you actually determine how much capital to put towards a risk? And to do so, we're actually going to go through some math. We're going to talk about the power of exponential functions because that's really the key to understanding how to manage capital for your portfolio. And I hope that this really enlightens some of you as to how to place your trades or how to understand how many contracts to trade when you're trading option strategies. Really, really important topic. It is a little different from the topics that we usually talk about, where we dive into an option strategy. However, I think this is probably one of the most important topics to learn about, so I want to spend some time to cover this today. Now, before I get started, just a little bit of housekeeping. Everything that we're going to talk about here today is simply for research and education. This is not meant as a recommendation or solicitation to trade or buy any securities, and this is not for any tax advice. So please, if you need any of those things, talk to a professional for those things. And just a reminder, for those of you that trade options here at Firstrade, you have $0 commissions across the board, whether you trade stocks, ETFs, options, or mutual funds. A really big help for those of you that trade options, because generally speaking, option commissions eat into a much larger percentage of your trade compared to your stocks and ETFs. So zero commissions for both the ticket charge and the per contract charge is huge in shaving your transaction costs down to zero here at Firstrade. So one of the things that I think is really beneficial for traders at Firstrade is the ability to trade options commission free. And just a reminder for those of you that do trade bonds and ETFs, Firstrade was rated #1 for ETF and bond investors by Kiplinger's. So you have a great amount of tools here at Firstrade, both with the options play tool as well as zero commissions across the board, but you also have a fair amount of research that's here designed to help make your trading more efficient. So let's go ahead and jump right into it. Today, what I want to talk about, #1, is the golden rule of risk management. I'm going to go over what that golden rule is, and then I'm going to spend the rest of the time walking you through why that golden rule exists and what is the math behind it. Those are the things that I want to convey here today. And to do so, I'm going to start off by talking a little bit about the difference between linear and exponential functions. Something that you probably didn't think you're going to have to learn about other than in high school math, but this is a really important topic to understand why we use the golden rule of risk management. Next, I'll talk a little bit about the high water mark. This is something that many of you are probably have some sense of, but may not have thought about it in numerical terms. So I want to talk about that high water mark and how hard it is to get past your high water mark. And that's really one of the things that's key to understanding why it's so important to manage your capital correctly. We'll talk a little bit about blowing up your account as well, because if any of you have traded options before, you may have even blown up your account before. So I want to talk about blowing up your account and what are the ways to prevent that, how to plan for not blowing up your account. And then lastly, I'll talk a little bit about consecutive losses, because this is really, I think sometimes traders have a misconception as to how many losing trades they can have in a row or what is realistic, what they should plan for. So I want to talk a little bit about what are some worst case scenarios and what does your account look like in those worst case scenarios so that you have a plan going forward. And then what we'll do is we'll end with a risk and money calculator. This is a free calculator that I've created to help solidify the things that I'm teaching here today, and to also give you guys a tool to implement what we're teaching you here today so that you can plug in your account size, you can plug in the risk per trade so that you can calculate the correct number of contracts to trade when you're trading your options account. So those are the things we're going to go over here today. Let's go ahead and get started with the golden rule of risk management. Some of you may have heard this before, especially if you've dealt with any type of professional trader or seeked any help in position management. You've probably heard people say never risk more than 1 to 2% of your portfolio per trade. And there's a reason for this, and today we're going to go over what those reasons are. But the golden rule of thumb with any trader is, generally speaking, that you don't want to risk more than 1 to 2% of your entire portfolio per trade. That means if you have a $100,000 portfolio, each trade should be risking around $1,000 to $2,000 per trade. And the goal here with everything that we're going to talk about here is to focus your time on controlling your losses, because that's what's going to allow you to be a successful trader. A lot of people think about successful trading as making lots of profit, and that's not the case at all. Talk to any professional trader, talk to any successful trader, and they'll tell you their success comes down to managing risk, not seeking high reward. And once you manage your risk, that's how you're going to be able to see how you have a path to being able to make money in trading. And the goal of everything here, the goal of having a golden rule of risk management, is to make sure that you have enough dry powder in your account to live another day. Because if you blow up your account, that's when you don't have enough money to continue. And that's the end of the game. And you never want to get to that point. So what we're doing here today is to help prevent you to get to that point where you've blown up your account and you no longer have any capital to continue. So how do we actually go about doing that? So in order to understand the things that we're going to go over here today, it's really important to understand the difference between a linear function and an exponential function. And the best way to show you is a simple graph. So a linear line looks like the straight line here, dollar for dollar as time goes on. You have a linear growth. So growth basically is constant over time, versus an exponential function is something that grows at an exponential pace. So exponential functions are really, really powerful. But if you've ever learned about compounding interest, you'll know that all returns in your portfolio is not a linear function, it's an exponential function, and this works both ways. So profits and losses are compounded, and they are very, very powerful, meaning if you have profits that are compounding, they will continue to grow at a faster and faster pace. However, the same is true for losses. If you have losses, they will grow at a faster and faster pace. And it's really important to understand the power of exponential functions in order to understand why it's so important to manage your capital correctly. And it's really important to understand that the gains and losses you have in your portfolio also grow at an exponential pace. So that's why it's so important to manage your risk, because if you don't manage your risk, they will grow exponentially and you will blow up your account very, very quickly. And the goal here is to minimize the risk. Minimizing risk in your portfolio is critical to preventing total portfolio loss. And those are some of the numbers we're going to go over here today. And what I'm going to do is I'm going to try to keep things as graphic as possible and to stay away from the math. But today, what I want to do is show you the power of exponential functions in the form of graphics to drive the point home as to why it's so important. So what I first want to talk about is the gains required to break even. So many of you may have seen these types of charts before, or maybe you've heard statistics like this, but the gains that are required to break even on a trade, it grows at an exponential pace. What that means is that once you have a loss, how much do you need to gain in order to get back to break even? Because the reality of all trading is that there will be points in your trading history where you will have losses. So it's really important to understand, what does it take to recover from those losses? Because once you learn this theory, it'll become really important it'll be really clear as to why you only want to risk small portions of your account. And the goal here is to simply minimize your portfolio drawdown because of this one specific concept. So what I have here is a chart, and the chart tells you on the bottom how much your losses are. On the top tells you how much gains you need in order to get back to break even. So if you lose 10% of your account, you need an 11% gain just to get back to break even. If you lose 20% of your account, 25% is now required to break even. 30%, then you need 43% to break even. As you can see, as you go further and further down the line, even though you're only losing 10% more each time, the amount of returns that you need to get back to your break-even point grows at an exponential function. So it's not like if you go 10% more, you have to gain another 10% to get back. You have to gain substantially more to get back to break even. And that's why it's really important to understand that when you have portfolio losses that are greater than 25%, it's very difficult to recover, because if you're down 30%, you now have to make a 43% return just to get back to break even. Those are difficult odds to get across. It's not impossible, but certainly very difficult. So if you can imagine, and I think many of you may have found yourself in this position before, where let's say you risk 10% of your account per trade. So let's say you have a $50,000 portfolio and you put on a large trade where you're risking $5,000. So now you put yourself into this category. So if you lose on that trade, you need 11% return on the next trade to get back to break even. But chances are you could have multiple losing trades in a row. And any of you that have traded options before, you're familiar that you can have 3, 4, maybe even 5 or 6 losing trades in a row. Sometimes you have just a lot of trades expiring on the same expiration, and they just all go against you, especially maybe towards the end of last year where you had a lot of long trades and the market just tanked. And all of a sudden you see 3, 4, 5, maybe multiple trades all go against you at the same time. If you're risking 10% of your account per trade, you can easily find yourself moving down the chain very, very quickly to the point where now you have to get 100% gain just to get back to break even. And that becomes a very, very difficult task to do. So that's why, in order to prevent yourself from moving too far along this chain, you have to make sure that you're risking a small percentage of your account per trade, so that even if you have 5, 6, even 10 losing trades in a row, you're not going much more past the 20-25% mark, because once you get past that, that's when it becomes really difficult to come back from. So really important to understand the power of exponentials and how it affects your trading, because for every 10% of your account that you lose, the more difficult it is for you to come back. And anything beyond 25% of your total account value that you've lost, it becomes very difficult to come back from. Next, I want to talk about how many trades does it take to blow up your account, because I think this is something that we don't really think about in concrete terms, but when I put it on a chart, it becomes really easy to understand. And what I'm trying to illustrate here by this chart is that for every 1% less that you risk on a trade, it results in a substantially larger number of trades that you can make before you draw down your entire account. And the goal here is to simply maximize the number of trades by minimizing the risk per trade, because you want to have as many trades in a row as possible that it takes to blow up your account. And the only way to do that is by minimizing the amount of your account that you're risking per trade. So if you're risking 10% of your account per trade, you could only take 10 consecutive losing trades before you've lost everything in your account. You have no more capital to continue. And for every 1% you reduce that by, as you can see, the number of trades that you can trade in a row without blowing up your account grows at an exponential function. So as you can see, when you move into the 5, 4, 3 category, you can start trading 20, almost 30, 40 trades in a row before your account gets blown up. And at 2%, you can risk 50 consecutive trades. Think about what it would take to lose 50 consecutive trades. I would think that you would probably stop yourself before you had 50 losing trades, at some point, to probably reevaluate your strategy or reevaluate what you're currently doing. At 1%, you would have to have 100 losing trades in a row. Think about making 100 losing trades in a row. Would you stop at some point to say, is this something that I want to do, or should I be reevaluating my strategy? I certainly think so. But I think that if you were risking 10% of a trade, you could easily have 5, 6, 7 losing trades in a row before you say, hey, maybe I'm not doing something right. Maybe I need more education, or maybe I need to reevaluate my strategy. But by that point, you've already risked 60, 70, 80% of your account. You only have 20% of your capital left. That's almost impossible to come back from, because as you can see, if I've lost 80% of my account, I now need a 400% return to get back to break even. So again, really, really important why you should not be risking 5, 6, 7, 10% of your account per trade, but be more likely to be on that 1 to 2% range, because you can, number one, have so many losing trades before you blow up that you would probably stop yourself and evaluate your strategy and maybe readjust your strategy and move on, and not be at a point where it's impossible to recover from. Because if you have 10 losing trades at 2%, you're still only at this 20% range where you need a 25% return to get back to break even. That's much more manageable. So again, just to reiterate, the goal here is to try to maximize the number of trades it takes to draw down your account. And the way to do that is by risking a small amount of capital per trade. And the smaller you are, the more trades you can tolerate before you blow up your account. And that growth grows at an exponential rate for every 1% less that you're risking per trade. So as you can see, if you're risking anywhere more than 5% of your account per trade, you're risking your results in 25% portfolio losses quite often. And that's coming from an experience as a trader, is that you should plan for having 5, 6 consecutive losses in a row in some point of your trading career. If you don't think you're going to get there, I think it's just a matter of time for you to have a bad month or a bad quarter where you may have these types of consecutive losses. So what I next want to talk about is the probability of having consecutive losses. So I talk about planning for having 5, 6, maybe even 7 or 8 consecutive losses. I want to take a look at what are the probabilities of that happening. So what I have here is the probability of having 1, 2, all the way through 10 consecutive losses in a row based on your trading strategies. So this is based on win rates. And win rates is usually based on the type of strategies you trade with options. If you're buying options, if you're buying calls and puts, you're going to find your win rates to be in the 30 to 40% range. If you're selling calls and puts, you're going to find yourself in the higher 60 to 70% range. Now, a lot of people will say, well, why wouldn't you want high win rates? And the answer is that when you have high win rates, you're going to have poor risk-reward ratios, but that's a whole different discussion for a whole nother ball game. But if you're trading debit spreads and you're buying calls and puts, you're going to find yourself here in the lower end of the range. If you're selling credit spreads, you're selling calls and puts, you're going to find yourself here towards the higher end of the range. And I think most people find themselves in their win rates somewhere between 40 to 60%. So if you have the win rates of 40 to 60%, the chances of having consecutive losses of 5 or 6 consecutive losses starts to drop into the 1 to 3% range. So as you can see, anything that's highlighted in red means there's less than a 1% chance of having that many consecutive losses. So if you have a strategy where you're winning 70% of the time, you have only about a 0.25% of a chance of losing 5 trades in a row. It's not impossible, but relatively low probability. But most, like I said, most strategies will find win rates in the 40, 50, 60% range. So it's very reasonable to have 5 or 6 losing trades, having or trying to plan for having 5 or 6 consecutive losing trades in a row. That, in my opinion, is a very realistic point. It may not happen very often, but I think anyone that trades options will tell you there will be some time where the market goes against you, and it's very likely where you could have 5 or 6 losing trades in a row. So whenever we're talking about planning for these types of trades, you want to make sure that you plan for having at least, in my opinion, 5, 6, possibly 7 consecutive trades in a row, and seeing what does your portfolio look like if you had 7 consecutive losing trades in a row, and whether you'd be able to survive that type of loss. So for example, if your goal is to keep the number of trades that you lose multiplied by the percentage per trade to be less than 25%. Because like we said before, if you lose more than 25% of your portfolio, it becomes increasingly more difficult to get back to break even and surviving and being profitable on your trading. And that's the goal here, right? Is to be profitable in our trading. So if you're risking 2% of your account per trade and we're tolerating 5 consecutive losses in a row, that equates to 10% of your portfolio loss. which is far less than the 25% that we want to stay within. So that's why, again, the golden rule of trading is that you want to risk no more than 1 to 2% of your account. If you risk 4% of your account, you're much closer to that 25% range, and you're going to find yourself losing 20 to 25% of your account maybe multiple times a year. And that's not a position that you necessarily want to put yourself in, where you have to claw yourself back from being down 25% of your entire portfolio multiple times a year. However, I will say that this particular chart sometimes is actually a little misleading, because you actually can have 5 to 6 consecutive losses in a row actually much easier than many of you may actually imagine. When I talk about 5 to 6 consecutive losses, I'm talking about 5 to 6 consecutive losses across different types of trades. What I mean by that is that if you have concentrated positions, you need to group them together. So if you have 3 trades that are all expiring on the same day, and maybe they're all long trades, that's not 3 consecutive trades. That's really only 1 consecutive trade. So as you can see, you have to distribute your trades across expirations, long, short, and even perhaps sectors to truly have these statistics reflect. Because if you have 5 trades all expiring on the same expiration date and they're all long, short, and you think that there's only maybe a 3% chance of losing all 5 trades, in reality, that number is not 3%. That number is actually much closer to 50%. Because if all your trades are concentrated in one single expiration and they're all long, think about what happened in December 2018. If you were long into your options positions, all it took is for one market to go against you, and you would have lost on all 5 trades very, very quickly. So that's why when we talk about the probability of consecutive losses, we're not just talking about 5 individual trades. We're talking about 5 distinctly different trades. So if you have 5 trades spread across 5 different expirations and they're a mixture of long, short, then you can say that the chances of me losing on all of those 5 trades is relatively small, maybe about 1 to 3% chance. But if they're all concentrated in the same sector and they're all concentrated in the same expiration date, you really are looking at the probability of loss of 1 consecutive trade. So keep that in mind. If you find yourself concentrating your positions, be careful. It's something to also consider. So for example, if let's say I'm risking 2% of my account per trade, and I have 2 trades per expiration cycle, and I'm planning for at least a 5% consecutive loss, that equates to a 20% total portfolio loss if I have 5 consecutive losing trades. So that is still within the acceptable range that we're targeting, which is less than 25% loss. So if you're risking 2% of your trade and you have 2 trades for different expirations, that's still within an acceptable range of loss. However, if you're risking 10% of your account per trade and you have 2 trades on per expiration and you get 5 consecutive losses in a row, you've blown up your entire account. So think about that. If you have your trades fairly spread out across 5 different expirations, but you have 2 trades per expiration and you're risking 10% per trade, you can lose your entire account in a bad month. That's really what we're trying to avoid here. We're trying to avoid losing your entire account and not having enough capital to come back from. And the last thing that I want to say is that you can mitigate some of this by placing stop losses. Now, the reason that we don't talk about stop losses as much in options trading is that many times when you get a big jump in a stock, you may end up losing your entire investment basically overnight or very quickly. So that's why stop losses don't always work when it comes to options trading. But if you are using stop losses religiously and you're using them on all of your options trading, you can mitigate some of these losses. So for example, if you do have a rule of, let's say, using stop losses at 50% of losses on every single trade, then if you're risking 2% of your account per trade and you have 5 consecutive losses, that normally would equate to a 15% portfolio loss. But if you're using a stop loss on it, that will equate to only a 7.5% portfolio loss if you use a 50% stop loss. Now, like I said, with options, you tend to get a lot of slippage. So even though you place a limit order or a stop order at 50%, you might get filled when you're down 60% or 70% or even 80%. So keep that in mind, that stop losses are not as firm on options as they are on stocks. So keep that in mind. But it is one way to help mitigate the total portfolio loss that you have in a portfolio. So from all of that, what do you get? What I have here is a very simple chart to help you reference how much you actually want to trade from a dollar amount based on the account value that you have. So if you have a $5,000 options trading account, you don't want to risk more than $100 a trade. You're going to find that to be fairly restrictive because there's not a lot of options that you can trade for under $100 a trade, but there are some opportunities for you. However, as you can see, if you're trading with a $5,000 options account, it is quite difficult to trade. Conversely, if you have a $25,000 account, you can trade up to about $500 a contract. Now you have quite a bit of flexibility to trade, in my opinion, at least 1 to 2 contracts comfortably with most options that you can trade, but it's really in the $50,000 to $100,000 range where you have the flexibility of really trading multiple contracts across pretty much all symbols with the exception of maybe just a couple. So what this really allows you to do is see where do you fall under in terms of your account value, because that will help dictate if you risk 2% of your account, roughly what dollar amount you should be allocating to each individual options trade. And then you can calculate the number of contracts based on the risk per contract. So for example, if you have a $50,000 portfolio, you can risk $1,000 per trade, which is 2% of 50,000. And let's say you're trading a option contract that has $200 of risk per contract. That means you should trade 5 contracts. So it's a really easy way to calculate exactly what dollar amount you want to trade per trade, and more importantly, how many contracts you want to trade based on that. So what we've created here for you is actually a really simple calculator, and you can access this calculator at this particular link. For those of you that want to write this down, you can access it. And what this calculator does is when you visit the website, you just click on download. It'll download an Excel sheet for you. And what it allows you to do is enter your portfolio value. You can even change the risk per trade, but by default, we're keeping 2% for you because that's the golden rule that we're teaching you here today. And what it'll spit out is the dollar amount that you can risk per trade, and you can use it to calculate the number of contracts for each individual trade. You just have to put in the max risk of each trade that you're about to make, and it will calculate for you the appropriate number of contracts to trade. So it'll help you work you through exactly what your dollar amount is that you have in your portfolio and calculate the number of contracts you should allocate to a specific trade. So what you want to do is you want to increase and decrease your trade risk with the portfolio value changes. So if your account value is $70,000 today, and 3 months later it grows to 100,000, you want to plug in the new portfolio value so that you're growing your trades as you go along. And vice versa, if you have some losses, you also want to put in those losses into your portfolio or change your portfolio value to a smaller amount so that you are constantly trading 2% of your current portfolio value. And you want to do this on a fairly regular basis. You don't have to do it every day, but you certainly want to do it, in my opinion, at least once a month to recalculate the appropriate number of contracts to trade per trade. And you never want to trade more than the number of contracts that the calculator spits out, because if you're doing that, then you're putting yourself at risk of potentially blowing up your account. So really important calculator to use, really simple calculator to use, and it will bring you a lot of discipline in helping you calculate the number of contracts, because I know it myself as an options trader. Sometimes I'm in a rush to place an order and I just guess roughly how many contracts I should trade. Or sometimes, I kind of just go off of feel based on how confident I am in the trade. Not a good solution. You want to make sure you have math behind understanding how many contracts you're trading. And the calculator keeps you on track, and the calculator takes the emotions out of doing that type of math. It does the work for you. So I highly recommend, for those of you that are interested in what we're teaching here today, to access this free calculator at the website here on the bottom of your screen. I will also put it in the chat window for those of you that are interested to see if you want a direct link. I just put it into the chat window for you guys to access. So just to review, you want to risk no more than 1 to 2% of your account value per trade. Keep in mind, the reason for this is because both returns and losses compound exponentially, and the only thing you can control is your losses. That's what you have full control over. And the only way to minimize your portfolio drawdown is by controlling your losses. You generally want to plan for a worst case of having at least 5 to 6 consecutive losses. And that means 5 to 6 distinct groups of trades. You don't want to group 5 trades that are all in the same expiration as 5 consecutive losses. That's really only 1 consecutive loss. And you want to just, again, distribute your trades across expirations, sectors, and even long short to help yourself spread that risk around so that you reduce your risk of actually getting those 5, 6, 7 consecutive losses in a row. So that's just a quick summary of what I'm here to teach you guys here today. Like I said, this is quite different from what we normally do. We're not here to talk about specific option strategies, but this is one of the most fundamental and most important things as a trader to learn in order for you to be a successful trader. Because if you're not sticking to these types of rules, you're going to find yourself losing a large chunk of your account quite often, and many times it's very difficult to come back from. So with that, I want to thank everyone for taking the time out this afternoon. At this point, I'll open this up for Q&A. If you have any questions regarding anything I just went over, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for. Deborah's asking, it's unclear as to what is the risk amount on a cover call. So cover call actually is one of the only strategies that is what we consider riskless, because you're not adding risk when you're selling a cover call. You're actually reducing the risk of your long stock position. So I would say that is the only option strategy that this doesn't really apply to. Does this strategy apply for trades? That's the only thing that this all applies to. Anytime you place a trade, you want to risk no more than 1 to 2% of your account per trade. Gregory's asking, is it reasonable to risk more than 2% if you sell credit spreads? Absolutely not, especially if you're selling credit spreads. You want to risk no more than 1 to 2% of your account per trade. So whenever you set up a credit spread, there's a max risk of that credit spread. You want to make sure you stay within that range for your trades. It doesn't matter what strategy you trade. You want to risk no more than 1 to 2% of your account, because these charts don't care what type of strategy you trade. If you risk, let's say, 10% of your account per trade on a credit spread, all you need is 4 losing trades in a row to find yourself in a hole that's very difficult to come out of. It doesn't matter whether you traded a debit spread, a credit spread, or an iron condor to get there. This math applies to all strategies. Roger's asking, please go back to the loss gain slide. I'm not sure which one you're referring to. Is it this one? Meaning how much is required to break even on a loss? If that is, then I'm leaving this up. Jorge is saying, thank you, very good money management for options trading. I've learned the hard way. Everyone has probably learned the hard way. As much as I can teach this to users, I tend to find that people don't really pay attention until they've actually gone through the pain of blowing up their accounts. And unfortunately, that just seems to be human nature, is that, even though we understand the math, we don't tend to really pay attention until we've actually found ourselves in the hole. I've certainly found myself in that situation before, and that's why I'm teaching this subject, and part of the reason we're teaching this is because December 2018 was a difficult time for a lot of traders. If any of you had long positions in December 2018, found yourself in a lot of pain, and if you had options positions that expired, you may not have had opportunities to come back from that in January. So many people found themselves losing 30, 40, 50, 60, 70% of their account in December. And this was part of why we are here to talk about this topic, because regardless of what strategies you trade, regardless of what markets you trade, it's not difficult to find yourself in these positions when you're risking more than 5% of your account per trade. Charles, you're very welcome. I really hope that you guys find this useful. I'll just share one thing with you, since someone asked about the credit spreads. I just want to walk everyone through the process of utilizing both options play and the calculator that I just showed you. So if, let's say, you want to sell a credit spread, and I have applied material here up. So let's say I'm bullish on applied material and I want to sell a credit spread. So I click on modify, I use our strategy constructor, and I create a short put vertical. So let's say I want to sell a short put vertical on applied materials, and here I'm going to collect $32 in premium, and I'm risking $68 per contract. So what I'm going to do is I'm going to go over to our risk and investment calculator. You can use this risk and investment calculator. So like I said, if let's say you have a $70,000 portfolio, that means you can risk $1,400 per trade. And the risk per contract here, like we said, was $68 for that credit spread. So that means for this particular account with $70,000 and the applied material credit spread that I'm looking at, you can trade 20 contracts, which is quite a bit of contracts because you're risking a small amount per trade, only $68 per trade. But if let's say I was trading something with a higher amount of risk, let's say I was looking at Apple instead. Let's say I want to sell a credit spread on Apple instead. Maybe this will give me same thing, bullish, short put vertical. Maybe here I'm risking $310 per contract to try to make $190. So now instead of $68 a trade, I'm going to risk $310 per contract. So now I can only trade 4 contracts. So this is designed to make your life easier in terms of doing the math behind calculating the number of contracts. Or another thing we can do is if you just remember the $1,400 that you're willing to risk per trade, you can also plug this into options play. So you can click on, we have a risk and investment calculator. So you can plug in, I want to risk $1,400. And options play will also calculate for you to sell 4 contracts of this put vertical. So those are 2 ways that you can utilize what the tools that are available to you here at Firstrade to make sure that you stay within an acceptable range of risk and prevent yourself from blowing up your trading account. Any other questions? Roger, you're very welcome. Don is saying, is it advisable to buy option to ensure investment? If your question is it advisable to buy a put option to ensure your investment? Absolutely. However, I will say buying a put option to manage your risk is an imperfect hedge, and you should only do that if there's a reason that you don't want to sell your investment. Meaning, if you feel that the markets are going to correct, the best thing to do is to move into cash and then buy back when you feel the markets are done correcting. That's the perfect hedge, especially when you have 0 commissions here at Firstrade that allows you to buy and sell stocks commission-free. That's a much better way to protect your investment during a market correction. But if there's some reason that you need to hold on to that position, you can't sell into cash and buy it back, that's the only time where it makes sense to buy put. Now, we have recorded webinars on hedging your portfolio. It is a slightly more involved strategy, and it requires you to have a better understanding of options, but it is a strategy that you can use to protect your portfolio if you must remain invested in your position. But again, I highly recommend that if you're trying to protect yourself against a market correction and you have the ability to move into cash, you should move into a cash and buy back later. What is a reasonable return one can expect from selling cover calls? That's a great question. The answer, we tend to find from our back testing is it tends to be in the 1 to 3% additional yield per 1 to 3% additional yield on top of what you're getting. So comparable to doubling your dividend yield on, if you look at the S&P 500, I think the dividend yield on that is roughly about 1.7, 1.8. So I think by adding cover calls, you're roughly doubling your yield of the dividend, in my opinion, is what you can reasonably expect. If there are no other questions, I just want to thank everyone for taking the time out this afternoon. I hope that you guys were able to download the Excel sheet. Again, I'm going to leave this up 1 more minute. Make sure you download the Excel sheet. It's really easy to use to help you calculate how much to risk per trade and help you calculate the number of contracts for each individual trade. This will help you stay within the bounds of the rules that we're showing you here today. And you're going to find that it's going to improve your trading when you are able to fully manage your risk on your trades. So with that, I want to thank everyone for taking the time out this afternoon. I hope you guys have found this useful. Next week, we're going to come back. We're going to talk more about option strategies, or in 2 weeks, rather, we're going to go back to our regular programming, teaching you about option strategies. And I will see you guys in a couple of weeks. Have a great evening.